Hello and welcome back to the Microlearning Institute. In this tutorial we look at an application of IAS 8, particularly in relation to an accounting policy change. Firstly, IAS 8 says that we must adjust retrospectively. So what does retrospective application mean? Retrospective application means adjusting the opening balance of each affected component of equity for the earliest prior period presented, and the other comparative amounts disclosed for each prior period presented, as if the new accounting policy had always been applied. So in this question, we're given the profit and loss elements as stated for year ended X8 and X9. We're then told that on the 31st of December X9, the company introduces an accounting policy change, and this accounting policy change affects what would have been the opening inventory valuations for each of the 2 years presented. The effect on opening inventory for year-end X8 is to increase opening inventory by $150,000. And similarly, the effect on year-ending X9 is also to increase opening inventory for that period. So firstly, we must restate our profit figures to reflect the change in inventory valuation. So the restated position is the original profit position of 1900, plus as we increase the closing inventory, that of course is going to increase the reported profit for the period. But of course, however, we also increase the opening inventory for that period, which has the effect of reducing reported profit for the period. So the restated profit figure for year ending X8 is 2,150. That restated profit figure, of course, is subject to tax at 30%, so the restated P&L components give us a profit after tax for year ending X8 of 1,505. Next now we need to consider what happens for year ending X9. And again, the original profit before tax of 2,600 is now decreased because of the effect of increasing the valuation of opening inventory for that period, because increasing opening inventory will reduce the reported profit. So the reported profit now restated is reduced from 2,600 by 400 to 2,200. Again, we must recognize tax at 30%, leaving us with a profit after tax of 1,540. After this now, we need to restate the opening equity. Now, the as stated opening equity was 840, but of course the accounting policy change increased the opening inventory by 150, which of course, as we noted earlier, had the effect of increasing our profit. However, we have to pay tax on that increase at 30%, and 30% of 150 is 45. So the restated opening reserves in this question are 840 plus 150 less 45. So that is 945. Again, we recognize profit restated from the previous schedule of 1505, giving us a year-ended reserves figure of 2450. And again, for year ending X9, we also recognized a profit of 1540, giving us a closing reserves figure restated of 3,990. Thank you very much for watching this short application of how IAS 8 is applied in the case of an accounting policy change from the Microlearning Institute.